Over the last several years, there's been many proposed and many changes that are coming down the pipe with flood insurance. The next flood insurance change, believe it or not, is April 1st, which is around the corner. So to do that, I'm going to introduce Patty LaShaw, which is going to be our guest speaker today. Patty is the Vice President and Principal Flood Coordinator for Wright Flood out of St. Petersburg, Florida. Patty's knowledge of the flood insurance is extensive. In addition to experience in her position at Wright Flood, she's also been the underwriter and trainer for American Bankers and insurance examiner for FEMA. She's earned the Associate of National Flood Insurance designation and received the Distinguished Graduate Award for the highest grade average in tests leading to this designation. So with that, I'm proud to introduce Patty.
Thank you. Good morning, everyone. Okay, we want to talk about flood. It's exciting here. So I was asked to come in and talk about specifically condominiums first and then go into the April changes. So there's 4 methods of insuring a condominium, whether it's an association or an individual unit owner. So an association can buy building and contents coverage for the entire building. A unit owner in that building can buy building and contents. But if it's a non-residential building, the association has to purchase the building coverage. They can buy building and contents. In a non-residential building, a unit owner, whether it's a residential unit or not, cannot buy building coverage. They can only buy contents coverage. So as far as FEMA is concerned, what is a condominium association? And they define it as an entity made up of unit owners responsible for the maintenance and operation of, as we know, common elements, other real property, and membership in the entity is a required condition of ownership. The named insured has to have condominium association if they're purchasing what we call a residential condominium building association policy, or what we call an RCBAP. If it doesn't have condominium association in the name, we have to look at the bylaws to make sure it is in the form of a condominium ownership. So to be eligible for the RCBAP, they has to be, 75% residential. Of course, we don't count the parking garage in that, even if it's attached to the building. We're just looking at the building itself. So as long as it's 75% residential, it has to be insured under the condominium association. And when it says regular program, when a community joins the flood program, they first start off in the emergency program until they get the maps done. And then once those maps are completed, then they come in what we call the regular program. So an association can't be in the emergency program. And the building's having a condominium form of ownership, of course. It's not allowed for HOAs. It's not allowed for co-op ownership, or if the building is less than 75% residential, it has to be insured under what they call the general property form. And the maximum coverage they can purchase there for the entire building is $500,000 on the building and $1,000 on contents. So if it's insured under the condominium association policy, the residential condominium association policy, I should say, it covers the entire building under one policy, including both the common as well as individually owned building elements within the units, improvements in the units, and contents owned in common. It's very different from a lot of other insurance in that respect. It doesn't follow the state laws. It follows the federal law for the National Flood Insurance Program. They can purchase up to $250,000 per unit, but they can't exceed the replacement cost of the building itself. So whichever is less, the $250 times the number of units or the replacement cost. And contents coverage, they can purchase $100,000. The Residential Condominium Building Association policy is the only policy that has a co-insurance penalty under the flood program. So the association needs to insure at least 80% of replacement cost or the maximum available. Otherwise, if they do not insure that, they will have a co-insurance penalty. So it's very, and this affects unit owners as well, which we'll get into. But it's really important that they are insured to at least 80% of replacement cost. And that's why, and some of the producers are in here, or if you're a property manager of an association, FEMA requires the replacement cost value to be updated at least once every 3 years when they go to renew that policy, because they want to make sure it's not underinsured. FEMA looks at buildings as either a high-rise building or a low-rise. Your high-rise is 5 or more units and 3 or more floors. Low-rise is less than 3 floors regardless of the number of units. But if there was like a crawl space here in this example, you know, under here possibly, they're not going to count that enclosure as a floor to make it a high-rise. The rates are different between a high-rise and a low-rise. The chance of a total loss or a large loss on a high-rise is much smaller than it is on a low-rise building. So, under the dwelling form, if the unit owner wants to purchase a flood policy, they can purchase building coverage up to $250,000 or contents for $100,000. Now, there is what they call under the dwelling form a loss assessment. And this is where it comes in, where say the association does not buy a flood policy and the unit owner buys one. And they have up to the building limit loss assessment coverage. So say they're on the 10th floor. They had no damage to their unit, but the first floor had major damage, including some foundation damage. They would be assessed in that association and their policy would come into play. There's also another example. Say they're in the building and there is a recreation building on the property, a clubhouse, something like that. Their building has no flood damage, but it destroyed the clubhouse, the floodwaters. They would have assessment coverage if they were assessed for that building. So that's how the assessment works. Now, the policy, if the condominium association purchases a flood policy, say they only purchase up to 80%, the unit owner could pick up the difference for the max to be $250,000. And that way, again, they would have that assessment coverage in case they needed it for their building or the other building. However, if the association purchased less than 80% and they have the co-insurance penalty, the unit owner no longer has assessment coverage. So it's like a double penalty there. So it's really important that the association purchase at least 80% or more for their coverage. So under the unit owner, the association, this is for a non-residential condominium building. So they can purchase 500,000 contents, 500,000 in building. The unit owner, residential or non-residential, again, they cannot buy building coverage, only contents coverage. Now, Biggert Waters, yes?
Talking about a high-rise or a low-rise building.
Correct.
You all make us insure 80% of the value when maybe 10% is exposed. That's not fair, is it? Did you hear me?
I heard you.
Good.
Thank you for your question.
What can you do about it? Because we're paying for exposure that we don't have.
Unfortunately, I can't do anything about it. It is a government program. Congress makes the rules, and they have to follow those rules. But they did start something with BW12, Biggert Waters That was Flood Insurance Reform Act that went into effect in 2012. And this is what they're saying now. FEMA hasn't implemented this yet, but it's really a hot topic where they want to implement this. So you're taking care of that, where the association, if they purchase less than 80% replacement cost, and the unit owner wants to protect themselves, then they can turn around and have coverage. They're not going to be penalized because of the association not purchasing 80%. However, I've been getting numerous calls on this, met with FEMA last week regarding this as well, and they are seriously looking at implementing this as soon as possible.
But on the higher level floors, the only people that really need coverage are the people on the bottom level because you don't have the loss assessment, correct?
Well, with the, if they're insured less than 80%, and they don't have that loss assessment right now. But that, you know, again, that could change very soon. But the way it stands right now, it has to be insured to 80% for them to have that loss assessment. Yes?
I have more of a comment. I get this question a lot on condos with first floor levels and, you know, why do I need it on a higher floor?
Right.
Why do I need a covered full replacement? Just, you could still have damage on a higher floor, even if floodwaters don't actually touch that floor. For instance, if the river levee broke and moved an entire building off of its foundation, it may not actually get floodwaters in there, but the building is total. So you need to have flood coverage up to 80% of the replacement cost value. Very unlikely, I understand, but that, I believe, is the rationale of the National Flood Insurance Program when they make that requirement.
Exactly, because
Any of the damage that came through the roof and down, it's going to be rising water.
Right.
correct.
Flood that causes the building to either move off the foundation or whatever could happen, and it ends up being total, then it would be a floodplain rather than a regular property.
Exactly. So when, I mean, because flood insurance does cover foundation elements, and we've seen where whole associations have been considered, you know, condemned because of foundation. And, you know, they had that flood policy, and although the unit owner's unit was not damaged, they had coverage for assessment coverage to cover their assessment. And I agree. My husband and I, we have a condo in Tampa. I live on the 9th floor. I'm not in a special flood hazard area, but I'm like a block away from where the cruise ships all come in. So I just bought coverage. I know I'll never use the contents, but I have some coverage because it's not an elevated building. It's all slab on grade, that when that first floor gets flooded, I'm going to be assessed. So that's why I chose to just purchase enough that I think I'm good for that assessment.
You mentioned earlier that every 3 years a replacement cost value assessment has to be done. Is that a new policy?
The question was, do you have to have that assessment, replacement cost value every 3 years? So for new business, it is required that we have a current copy of an appraisal to have the replacement cost value. And then a letter goes out on the 3rd year renewal asking for an updated one.
But that's a new policy. I haven't seen that. That's a new.
No, they started that about 5 years ago. About 5 years ago, I believe. So some changes for April. FEMA comes out with updates to the flood program. Every April, there's some kind of a rate increase. Also, underwriting guidelines, or they try to implement either sections of what we call the Bigger Waters Flood Insurance Reform Act, or the new one called the Homeowners Flood Insurance Affordability Program, or we lovely call it HIFA. And the first thing is there is now a $10,000 deductible available. We're going to talk about that. And they made some changes with the substantially improved structures. And then if you have a map change, there's a new, what they call rate table for a map change. They're implementing the HFIAA, HIFA. They're now having a surcharge on all policies. There's the reserve fund. Federal policies are increasing. As I mentioned, the rates are increasing, as well as we'll talk about non-primary and severe repetitive loss properties. So first, the deductible. If it's a 1 to 4 family, the maximum deductible anybody could purchase was $5,000. So starting in April 1st, they're going to allow $10,000. This is part of HIFA requirement. Congress wants that every time a flood policy is sold to an insured that is 1 to 4 family, and that includes a unit owner, that they tell them they can get up to, a $10,000 deductible. It's about a 30 to a 52% cost savings, that higher deductible. The problem is not a lot of mortgage companies, if there's a mortgage, is going to accept that $10,000. So you really want to make sure that the insured yourself has checked with their mortgage company to see if they will accept that $10,000 deductible. So substantially improved. Previously, the substantially improved properties became what they call post-firm. And post-firm means it was built after the community joined the flood program. So it's supposed to be built in compliance with floodplain management. Number one rule of floodplain management is that communities will adopt that lowest livable floor has to be at or above the base flood elevation, where they think it's going to flood to. So that's what we refer to as post-firm. Firm stands for flood insurance rate map. So when that map comes into effect, they want to make sure everybody's being built with that lowest floor above. April 1st, they're not going to do that. They're going to say, okay, if that person wants to stay getting subsidized rates in what we call pre-firm, built before the community joined the flood program, where those rates are subsidized by the government, that they can stay in there, but they're going to see their rates increase 25% a year. So that's the maximum it's going to go up to. And when we talk about the rates, we're not talking about including the surcharge, the HIFA surcharge, or the federal policy fee, or the reserve fund. So that's not included in that maximum of that 25%. Newly mapped. Dwayne LeBlanc's here. I know he's going to be talking with the producers at Eagan regarding the map changes. I believe they're looking at September. Is that correct? Okay. So this would come into effect if those new maps are adopted. So newly mapped, Congress says, well, if I'm not in a high-risk area, so a B, C, or an X zone, and all of a sudden the map changes and puts me in an A or a V zone, that's a special flood hazard area. That's your higher risk flood zones. So if they do that, you don't want to pay those large rates. Say the house was built back in 1930. It's not elevated. All of a sudden you want to be charged, extremely high rates. So they say they can have the preferred risk policy rates. A preferred risk policy is B, C, or X zones, your moderate or minimal flood hazard zones, and is a building contents combination, and it's at a very low cost. So they're going to allow them to have those rates, but then they're going to charge the applicable federal policy fee, reserve fund, and HFIAA assessment on top of that. So it's not going to be as cheap as the preferred risk, but it's much better than going into a special flood hazard area in most cases. Now they do recommend that an insurer purchase an elevation certificate, And if that elevation certificate shows that that lowest livable floor is at or above the base flood, their rates could be actually cheaper being rated full risk than under this program. So at Right Flood, what we do is if somebody gives us an elevation certificate, we're not going to use it until it becomes beneficial to the insured. And it could happen the year after or in 5 years. So each year the system's going to look and pick what is the most favorable rate for the insured. Properties that are not eligible is if they've had prior loss history on that property. Then they have to go into that special flood hazard area. Yes?
Your previous screen, when you talk about the new mapped areas, those are going to take, they haven't taken effect yet, the ones in Jefferson.
Right, right.
And if I'm correctly, it says the ones that are newly mapped into high risk from S to A between 2008 and March 31st. We haven't implemented the
Right.
maps yet, so how are we going to take advantage of this new coverage if we haven't gotten our new rates yet?
Right. So when the map changes, this newly mapped rates goes into effect in April. So if I have a map change in September, I'm still eligible. It's if
Even though it says until March 31st.
that is if the map changed between 2008, because you have to purchase a flood policy within 1 year. That's the new rule in April. So if the map changes September 2015, you have until a year later to purchase that flood policy. You're welcome. HFIAA surcharge. This surcharge is mandated by Congress. And what it is when BW 12, that Flood Insurance Reform Act, went into effect, it affected a lot of people that were pre-firm properties that were built before the community joined the flood program. If you wanted to buy a brand new policy, you just bought a house, you would have to be rated with full risk rates. We saw rates for single family homes in like $40,000 a year. So Congress, that was the unintended consequences, they said. They turned around and passed the Homeowners Flood Insurance Affordability Act, HIFA, and took that away. But in Congress, they are required, it's the pay-go rules. So if you want to reduce that, somebody else has to pay for it. So that is what that surcharge is for. And that surcharge goes into what they call the reserve fund. And that's only to be used for future flood losses. As some of you may know, the NFIP is in $24 billion worth of debt. So they want to build up a reserve fund to pay for future losses so they're not borrowing more money from the Treasury, because when they borrow the money, they have to pay it back with interest. So that is the whole theory on the surcharge. So if it's a primary residence and it must be a single family building or a condominium unit owner policy, and it's their primary residence, meaning they live there more than 50% or more of the year, then they have $25 surcharge. If it's not their primary residence, or it's a other residential building or condominium association building, the surcharge is $250. So again, I'm just waiting for them to say unintended consequences and then turn around and want us to refund it, because I think it's building up a lot of steam. People are very upset about this. People are trying to buy a second home. Doesn't mean you're rich having a second home, and having that additional $250 is a lot of money for people. So they're looking at that. I don't know if they're going to, again, Congress is going to have to do something about that. FEMA can't. The write your own companies, insurance companies can't do that either. So, and just to know that the agent nor the company is given any commission on these surcharge. So the HFIA surcharge, that every penny of it goes into the reserve fund. Then they have the reserve fund fee. That started last year, where it was 10%, or excuse me, 5%. So it was 5%. Now they've raised that. Before, the preferred risk policy never had the reserve fund cost. Now they are, and they're going to have a 10% on top of that for the reserve fund. If it's newly mapped, their reserve fund fee is 15%, as well as all other policies. So the condominium association policy, unit owners, everybody would get that 15% unless they were in the preferred risk program. They're the only ones that get the 10%. So that also went up, as well as the policy fee. So the reserve fund and the HFIAA, all of that, every penny that's collected goes into the reserve fund for future flood losses. The federal policy fee is what they pay their staff, and for mapping and for education and marketing for FEMA. So as you see, those went up. If it's a single family, you're seeing it went up by $1. However, if it's a unit owner, if it's a condominium association, it depends on the number of units within each building and how much that federal policy fee is. As you can see, it really did go up quite a bit this April. So if it's 21 or more units in there, right now the fee is $924, but starting April 1st, that has gone up to $1,800. So that's quite a jump.
So could you find yourself in a situation where you had a 35% increase plus these other 10% and 15%?
The rates themselves cannot exceed 18% except for severe repetitive loss, and we'll talk about the exceptions, per year. That's just the rates. So again, yes, you can see like a 30% increase because you've got the reserve fund and you've got the HFIA surcharge and the federal policy fee. Yes.
And you're able to tell us the full risk rates, like at the present time? You have the charts for the full risk rate, so we know where that potential high level is going to be, because we're increasing 18% a year and it's cumulative.
It's up to 18, so sometimes they don't increase the whole 18%. So we have, if you want full risk rates on a special flood hazard area, an A or a V zone, you have to have an elevation certificate to determine what the true full risk rate is.
And you can determine that, right?
Yes.
And you know which properties have been substantially damaged that could have been part of the road home program?
FEMA has a list.
I know. Give it to us.
And we can actually tell in our system whether they meet the substantially damaged properties. And because those properties we can't write under right flood, or any other insurance company can't write that for the government under the NFIP program. It has to be written directly with the NFIP. So the NFIP has those policies. So once somebody becomes a substantially damaged building, their policy goes over to the NFIP. And until it's rebuilt or they fix it so it's compliant, will it be taken out of that?
You know, even if they were substantially damaged, they got an elevation certificate, they were supposed to be raised, they weren't raised, but you know, you can issue a new policy through the NFIP.
Through the NFIP direct. Yep.
There's no duplication of benefits, so therefore if there's another flood, that house would be responsible for paying back that grant. That's what we're running into in, you know, residential sales.
Yeah, and you know, and this is unfortunate because there's a lot of times the insurance and the mitigation and the mapping, they don't talk to each other. when they start implementing this and how one truly affects the other. There's what they call the community rating system. So if a community goes above and beyond basic floodplain management guidelines, they actually get what they call a discount. So the policyholders can get between a 5 and a 40% discount depending on the class of the community, what they do for loss prevention. And, you know, with the substantially damaged buildings, if they don't comply within a certain time period, they could actually lose credits on their CRS discount. So it affects so many areas, but people are not talking, letting people know, you know, what the consequences are if they don't comply. And some of those.
To kind of drill down just a little bit more on that. Arguably 83% of New Orleans was underwater. The elevation grants to raise the houses, people either did it or they didn't. The people that took the money and didn't, and then have moved on and sold their property, somebody else has moved in and bought the property, only to find out, and got insurance, got a flood policy probably, but they'll never get paid in a flood. So these properties all of a sudden become unmerchantable.
No, because flood insurance is available. I mean, even though you've been substantially...
Flood insurance, the flood people have already paid for the building to be raised. When they find out and the lender is stuck, and a whole series of people down the line, including the realtor.
Yeah, and the HUD IG came out and said that 80% of the people that received the money didn't raise their house.
Didn't raise their house.
Did not.
Yeah, that's where they've got to get into mitigation, because then you've got a problem there, a huge problem there.
Yeah.
Yep.
We have a giant problem that no one's talking about.
That nobody wants to. Yeah, and that's one thing they should be discussing right away. I mean, if they took money to elevate that property, that building, and they did not, you know, that could, you know, not only affect the insured who bought it, but also the community with their CRS discount, if they got a discount, because they shouldn't have been allowed to sell that property until it was elevated.
A lender steps into the picture, a new lender, on a fraudulent transaction, and creates an immersible piece of property.
You know, even though that insured did purchase a flood policy, I know nothing of where they wouldn't pay on that flood policy, even though the property they did not elevate. They would be charged higher rates, but I honestly do not know that they would deny coverage for that.
What happens is when the preliminary maps, you know, the effective maps come out and you are no longer in a flood zone, you can get the insurance based on flood zone X on your elevation certificate. However, that house should have been substantially damaged and received road home money, not raised, but they did gut and fix it up. Basically putting lipstick on a pig.
Right, right.
And they sell the property, and you now in a new flood zone, you know, they've already paid, so there's a no duplication of benefits provision, and I've talked to the FEMA floodplain manager about this. There's a no duplicate, you know, benefit provision.
Right.
So even if that person does get flood insurance through the NFIP, if there comes another flood event, they won't pay that person, because the flood insurance stays with the house, that person's got to pay off that grant, and then they will issue the flood insurance, is what I was told by the group insurance.
You know, I honestly don't, I've not heard that before, and I will find out, and I will let, you know, Marcus or somebody at Eagan know, reach out, because I've not heard that before. You know, and the road home, I don't know if FEMA is tracking the road home. They're tracking federal grants, you know, and whether it was substantially damaged or not. But a substantially damaged building can purchase flood coverage and have coverage. You've got a new owner. So I don't know, and that's, I honestly don't want to give the wrong information, but I have never heard where they'll deny the flood payment for that. I've not heard that. I don't know, Dwayne, have you heard anything like that, or Diana?
It's a question that's come up, and it's always come up on the group insurance side, so I'm not familiar with it.
Right. Okay. All right. No, but I will check with them.
Particularly if you took a grant and signed all the documents, sold the house, took the money and ran, did you just perpetrate a crime?
I believe you have. Yeah. That is, I mean, you're taking money to elevate a building, specifically to elevate that building, and you do not, and you take off with the money, I would consider that right.
When we drive around, there's not
Right.
a whole lot of elevated houses.
No. You know, but I will say after Katrina, and, you know, a friend of mine, she lost her home, slab on grade, water up to the roof, you know, gutted the entire house, but St. Bernard Parish said it was only 49% damaged. So they didn't hit that substantially damaged. So, you know, and to me, that was substantially damaged. You know, we have to gut the whole inside of the house and rebuild like that.
If you got to visit your house on a boat, I think it's probably...
Exactly. Non-primary and severe repetitive loss properties. If it's pre-firm, built before the community joined the flood program again, they will have that 25% annual increase, up to 25% annual increase every year. So again, that does not include the fees. Define every year?
The actuarial rate, which nobody sees, they just tell you when you've met it.
The actuarial rate, you won't know until you receive an elevation certificate. And that's why it's important, some of these pre-firm properties, to go purchase an elevation certificate, because at some time it is going to be more beneficial than the 25% rate increase every year. So for our resources, I highly recommend floodsmart.gov. It is geared towards the consumer. It has a lot of information, like if you have questions about a map change. And you know, when there is a map change, there is an appeals process. So if I was going from an X zone into a high-risk area, I would want to take a look at that map before it becomes before it's adopted, to say, hey, maybe, are you really sure? I'm kind of like on a knoll. I don't think I'm in that special flood hazard area. That is a chance for you to let them know you're not in agreement with it. If you have some documentation to prove it, like an elevation certificate, something like that, where you can be taken back out of that special flood hazard area. So they have information on map changes, they have information on the surcharges, any type of change like that, you're going to see that in floodsmart.gov. But it's written more, instead of talking to insurance professionals, it's talking to the consumer. They also have an agent site for agents to get information as well. But that is a very good website, especially if people have questions on, do I really need a flood, policy? Why is my mortgagee requiring I purchase a flood policy? Things like that. So again, any information, just our intent, but questions? Yes.
You mentioned the change of flood maps. What is the status of that in Orleans and Jefferson? I understand they've been approved by the council, or tell me where we are.
You know, honestly, I'll let Dwayne speak to that. He's been working with them. And yes, you had a question?
What's happening with non-residential commercial?
So non-residential commercial properties, rates are going up. Now, starting in October, non-residential, FEMA wants to find out, because part of the HFIAA Act says that they want to distinguish what is really a non-residential property. Is it a business? Is it a nonprofit? Is it like a church, a house of worship? Or is it a small business? because in the future, those rates are going to be different. They're not going to be, they're going to give like House of Worship, nonprofit, less of an increase, but for right now, that's not going to happen until next year. They've got to start getting that information because we've only collected, is it residential or not residential? So we don't know. Of course, you would know if it was a church.
Know about these fees and reserve fund, you know, the commercial business?
The reserve fund, non-residential, their reserve fund's going up to 15%. They're going to have that HFIA surcharge of $250, and the federal policy went up $1 for the non-residential.
That's all that's going on right now.
Yeah. So starting April 1st going forward, you're going to see that surcharge. You've already paid yearly on those other fees, or the federal policy fee last year on the reserve fund. Now you're going to see that $250 HFIAA surcharge.
The same apartment building that's individually owned. One person owns the apartment complex.
One person owns, exactly, because the $25 is only if it's a single family dwelling of the named insured and they live there more than 50% of the time, or a condo unit owner. There was a lot of discussion last week when I was at a conference with FEMA regarding some of the changes they want to implement in October. And one thing was to get the information on non-residential businesses. The other thing is the mortgagees brought up is there are some private insurers out there that are taking on some of this flood risk. So what's the implications with the private insurers? FEMA is encouraging private insurance. However, what I know today that could possibly happen in October, and Joyce Shug asked me to bring this up, is if I'm a pre-firm property and say I get an elevation certificate and I'm 4 feet below the base flood, so I don't want to pay those rates, I'll pay the subsidized rates until 4 feet below is better. So I'm going to pay those subsidized rates. But all of a sudden I see, you know, I get offered private insurance and it's a much cheaper rate. Of course, I decide I'm going to go. I have a mortgage company. The mortgage company says, yes, we accept this flood policy, this private insurance. 2 years later, the private insurance says, it's too big of a risk. We're not renewing you. They come back to FEMA because the mortgage requires flood insurance. FEMA is going to look at that as a lapse in coverage for NFIP. So if they try to come back into the program, they're going to have to be rated at that -4. It's the most current flood map, and base flood elevation is what they're going to be rated as. So although I'm not dissuading anything about private insurance, you just really, I think they need to know that before purchasing it, especially if, really, when it's a pre-firm building in a special flood hazard area, and if a mortgagee required it. But say they sold the house, they had the private insurance, and they sold it to somebody. That person's not going to be penalized. They could come in with those subsidized rates. That's what's a little bit different from what Biggert Waters was, where they said any new business had to be rated full risk rates a couple years ago. That's the difference here. So if it's a mortgagee-backed loan and they require flood insurance, they need to keep that flood policy with FEMA, you know, if it's a pre-firm building in a high-risk area, unless their elevation certificate's good, you know, but that is something definitely to keep in mind. So does anybody else have any other questions on condos?
Could you, on excess insurance, you get the 250 and one, and then go private to get excess?
Yep. Absolutely.
All right, so then the next question would be, is excess insurance available still through the regular lines of
Yes, there are, you know, we have some excess ourselves that write flood. There's other companies out there that do write excess. Not all insurance companies write excess for flood.
But wouldn't it be smart to try, is it affordable or not?
I think it is affordable. You know, they're not, I will say if it's a pre-firm building built before the community joined the flood program in a high-risk area, they're gonna take a look at that very closely before they go on to that risk for excess flood. Yeah. Does anybody else have any other questions? Yeah. Oh, no? All right. Oh, yes.
I've gotten some calls recently and received some of these letters myself, but Right Flood and it looks like the letters are from FEMA, just requesting a return signature, acknowledging you've received your policy,
Yes.
any loss date. These things, again, just in my opinion and from the clients that have called me, seem to be, what do I do with this? Why am I receiving this? It seems like it's just a waste of money in a program. We all want to make sure that is efficiently run. But again, just a question, and it's taking up too much time.
No. No, that's okay. That happened back in 2004 Flood Reform Act. Congress mandated that FEMA send out at every renewal of a flood policy an acknowledgement form, claims handbook, and any loss history, so the insured can see the loss history on the property, on that building. So they are required to send that out at every renewal. The acknowledgement form, believe me, there's no penalty if you don't sign it and send it back in. Half the people don't. I've seen where they do send it in, have some choice words for the flood program, but technically, they don't have to sign it, and I totally agree with you. I mean, we've got to start looking at the number of documents FEMA requires to be sent. In that case, as you know, for new business, I think it's good that we do send, if it's new business, but for renewals year after year, you know, are they reading it? When you start bombarding insureds with so much in the mail, they're going to stop reading it. Send them what they really truly need to know and read. You know, I agree. Yes?
Those dollar amounts that they show as damage, can that be used as a deductible on a future loss? Where FEMA says, prove to us that those repairs were made.
They will, you know, at the next loss, you know, but there's not a next loss, but if they do have a loss, they will look at it and they will say, you know, were these repairs made? You know, if they weren't made, then they're not going to pay twice on the same.
If they were made, what documentation do you need to convince FEMA that they had been made?
You know, I'm not a claims expert, I'm sorry.
Disaster recovery unit has the list,
Yeah.
but they won't release it. They won't release it.
The list of what is needed?
No, they have a list of the homes that received grant money. So
Oh,
you can
okay.
look and see if they received grant money, and then you can compare it to whether the house was actually raised,
Right.
whatever, but we can't get that list.
No, because of the Privacy Act.
Right.
Because of the Privacy Act. But I think his question was if I had just a normal flood loss and then I had another loss on top of it, how do they know, you know, would they, if I didn't fix the front door, they wouldn't pay twice for the front door. However, if they did fix the front door, things like that, just your basic receipts, you know, but if it's a total loss and it floats away, you're not going to have those receipts. It's a cat loss. But I think in the claims handbook that FEMA has that they send out every year at renewal, it kind of gives you information on what you need to have for a flood claim. You know, what kind of receipts are you going to be looking for? Okay. But, you know, with the Privacy Act, it gets very, I mean, we've been pushing as a company, as well as other companies with us, on having like a database for elevation certificates. Here, they're not as expensive, but the average elevation certificate in the United States is between $500 and $600. You know, and I've seen them in upstate New York at $1,200 they start, and that's for a single-family home. It'd be nice if we just had a database and not having the insured go out and purchase a new one or try to dig up an old one, especially if they purchase that home and they have to have an elevation certificate. So, any other questions? I thank you very much for your time. It was very nice, and I wish you all a good day. Thanks.